Hey traders, welcome back. I'm DD. Thanks for coming back, seeing another video. Today we're going to talk about positive expectancy. And guys, if you like these videos, please like them, subscribe, hit the notification bell, and we'll keep coming back and giving you more videos. Positive expectancy. Okay. I guess the idea is basically it hurts to lose. It hurts to lose every time. It gets better over time because you start to appreciate a little bit more who you are as a trader. But it definitely still hurts. And one of the things that helped me understand better how to deal with losses was positive expectancy. And you'll see why, especially if you never heard about it and you don't know what it is. So it's a formula. So what's the formula? But before we get into that, there are three factors. Number one, you need to know before each trade how much you're willing to risk on the trade. Okay, so if you're one of these guys that sees an amazing setup and you're like, wow, this is gonna win everything for me, I'm gonna go 5 to 10% on this, even though you usually trade a 0.5%. It's gonna be difficult to figure out your positive expectancy. You're gonna have to see a lot more trades. But let's assume you say you trade 1 to 2, 3%. For every trade, no matter what. Then you also need to know before each trade how much you will earn if you win the trade, right? So you need to have pretty good, take profits. What's your target and what's your risk? For example, let's say I have $1,000 account and I'm gonna risk $50 on each trade, and I only trade if I could make $100, which is a 2-to-1 ratio. So that would be those two things. I know how much I'm risking, and I also know how much I would earn if I would win. And it's consistent. And then you got to have a nice history of trades to sample. Okay, those are the three factors. Now, the formula is your win percentage times the amount of money you earn per win minus your loss percentage, how much money you earn per loss, or how much money you lose every time, right? Okay, so that's the formula. That doesn't make any sense unless you have an example, and here we go. Okay, so here's trader number one. So again, here's the formula: the win percentage times the money you earn per win minus the loss percentage times money you lose per loss. Okay, so here's the example. Let's say trader one has $10,000 of trading capital. Okay, good. Now he risks 3% of his capital per trade, which means that he risks $300 per trade, right? He has $10,000, and on every trade, he risks $300. Good. Now, he trades a 2-to-1 risk to reward ratio, which means that for every win, he will earn $600, right? You're still holding over here? He has $10,000, and he risks 3% per trade, which means that he risks $300. And for every trade, there's a 2-to-1 risk to reward, meaning he's risking $300 and he will make $600 if he wins. So, and in his last 50 trades, he won 20 and he lost 30, right? So every trade, he risks 300 to make 600. He never does anything else. He only loses 300. He hits the full stop out at 300, or he wins and takes profit at 600. And in the last 50 trades, he won 20 and he lost 30. So that's a 40% winning percentage, right? 20 out of 50 is 40%. So here's the formula. 40%, which is his winning percentage, times $600, which is the amount he would earn per win, minus 60%, which is his losing percentage, times $300, which is the amount he would lose per loss. So if you take that 40% times 600 minus 60% times 300, it gives you $240 minus $180, right? 40% times 600 is $240, and 60% times 300 is $180. So basically, it's $240 minus $180, which is $60 per trade. Do you see what's going on over here? He has 50 trades, and he's making $60 per trade. What are you talking about, DD? He lost 60% of his trades. He traded 50 trades, and he lost, what did he lose? 30 of the 50. And you're telling me that he's making $60 per trade? How could that be? Because that's what's called positive expectancy. You have to look at your trades as a series of trades. It doesn't matter if you have like an amazing setup. Don't go trading 5%, 10%, or anything more on something that looks amazing, because the market is random, and you have to understand that with your trading method, assuming that you've proved it to some extent, with your sampling of trades, you're going to see that no matter how much you lose, you still might win per trade. Because look at this guy, trader number one. He has $300 per loss and $600 per win. He lost 30 out of 50. But since he has that win risk to reward ratio, if he's making more than he's losing, he still could win even with a 40% win ratio, right? And it's $60 per trade. So in those 50 trades, he made $60 per trade. He earned $3,000. 50 times 60 is $3,000, which is 30% ROI on his $10,000 capital. Let's take another example. Trader number two. So again, we have the formula, and we have the $10,000 trading capital. And this guy risks also $300 of capital per trade. So he has his $10,000 and $300 per trade. And now he trades with a 3-to-1 risk to reward ratio, which means for every $300 that he risks, he will make $900. And again, he gets full stop out for $300, doesn't manage to trade, or he gets $900 when he wins his trade, when it hits the profit. Now, in this trader's last 50 trades, he won 15 and he lost 35, which is a 30% winning percentage, right? 15 trades out of 50 is 30%. But again, he makes $900 per win and $300 per loss. So the formula says 30%, which is his winning percentage, times the $900, less 70%, the losing percentage, times $300, equals $270 minus $210. Again, $60 per trade. So this trader, even though he loses 70% of the time, he makes $60 per trade. And he also, if he's making $60 per trade, he's exactly like trader one, and he earned $3,000, which is 30% of the 10% cap of the $10,000 capital. So you see over here that, you know, when you have a risk to reward ratio that you always go for, it helps, and you don't need to win every time. And if you could appreciate that because you have a series of trades to show you that, then you're more comfortable losing trades because you understand that each trade is really making you money over time, and you could prove it with this positive expectancy formula. And therefore, when you are sitting in a trade and you had an impulse move that's going up and you're like sitting nice and pretty and you're really close to your target and it starts to go down, and you get that feeling in your stomach like, ooh, should I get out? Should I get out? And it's going down and down and down and down. Whoa, and now you're even near break even. And then you're even lower than break even, and you're waiting for it to go up, and it doesn't go up, and you get stopped out. And you were this close to your take profit, and you get stopped out, and you're just like, why do I do this? I had so much money sitting on the table, and I just let it go to the stop out. But if you understand positive expectancy, you don't care, because you look at your trades as my wins make me this, and my losses take away this. But overall, I understand that if I look at my trades as a series of trades, then this is what I make per trade. Okay, so a couple things that I want to speak out about this. Number one is when you do scaling in and out of your trades, so this just makes it all the more complicated, right? If you're going to say like, you know, a lot of times to see these traders online, and we only see traders online because how many times do you actually see traders in real life? Okay, that's another conversation. But when you see these traders online and they're like, okay, I'm going to risk, you know, this amount, and, you know, I'm going to take my profit all the way to like who knows where, and it's like a 14-to-1 risk to reward ratio. Yeah, after like 20 pips, they're like scaling out, and then they close, then they move their stop to break even, they get stopped out, and then they get in again, and then they get out. So these types of trading management is like really hard to figure out your positive expectancy. I mean, if you do have like 1,000, 1,500, 2,000 trades, then you could just like kind of like see an average and say, hey, look, I made 1,000, I made 2,000 trades, and I see this is what I make per trade. But you're not appreciating your positive expectancy, because why are you getting out, in the middle so early? Like, if you see that that's really your take profit, then wait till your take profit. And it shouldn't hurt you so much to go to your stop loss, because who cares? I still made money on my loss, right? So, and then there's one other thing I want to say. This is like a mistake that people make, with positive expectancy. Like, let's say I have over here like a 6-to-1 risk to reward ratio, right? For every, $300 that I risk, I make, $1,800. So people might think like, if that's true, then I only need to win 16% of my trades. As you can see over here, 16% times 1,800 minus 84% times 300 equals 288 minus 252, which is $36 per trade. And over 50 trades, it's $1,800 earned, which is nice 18% return on investment on your $10,000 capital. So this does make sense according to the formula, but are you ready and prepared to lose that many trades? Like, to go for the 6-to-1 reward ratio every time, which means you're going to take a ton of losses. In 100 trades, you're going to lose 84 times. Now, first of all, you might lose 84 times in a row. Not only that, it doesn't actually work when it comes to the randomness. Like, you could lose like 200 times in a row, and over 1,000 trades still have that 16%, win ratio. So you just might blow out your account. And if you're going to do this, you have to really risk like a very small amount of your capital per account, like, I don't know, 0.5% or even like 1/4%. Because if you're just going to lose and lose and lose and lose and then have those big wins that'll make some of the money back, but you could lose and lose and lose and then just lose and blow your account out. So you got to be a little bit careful on, losing too much. But, when you're going for the 2-to-1 risk to reward ratio that we saw before, the 3-to-1, and you're winning 40% and even 30%, that's doable. And that really helps you understand, that this trade doesn't matter at all. This trade is just one trade, and it's a series of trades. And I can walk away once I set my take profit, and once I have my stop loss set in place, and just let it go random. Let it lose. Because I've seen over my past 50 trades, 100 trades, 500 trades, that this is how I trade. And these are my results. And therefore, once I hit that buy or sell button, I know I made $60 per trade. I know I made whatever I made per trade. And that's a good feeling. And therefore, you don't get all caught up in like the emotional imbalances of risk management. So I thought that was really an important thing for me, to see my trades as a series of trades and to see the market as random. And I hope you take the lesson as well and stop fiddling around with all your trades and getting out too early and moving everything to break even and being so afraid to lose. Because that's just, it's a stressful way to trade. And if you trade without that kind of stress, then you're probably going to do a lot better. So, guys, this is my video on positive expectancy. I hope you love it, and I hope you like, and I hope you subscribe, and we will see you on the other side. DD out.